Okay. Thanks everyone for joining. Welcome. We're here to discuss the book, The Money Problem by Morgan Ricks. Over the last couple weeks, we've been reading through the book and discussing amongst ourselves. But now we have Morgan here to join us and kind of discuss in more detail and help clarify all the things that we didn't quite get right. Morgan Ricks is a professor of law at Vanderbilt. He's the author of The Money Problem, which we've been reading. And before Vanderbilt, he has previous experience working on financial policy at the Treasury Department and in the private sector, working in places like Citadel and Merrill Lynch. I'm going to keep the biography short and just go ahead and turn it over to Morgan, who can give us kind of an introduction or kind of a review of the main themes and messages from the book. And then we can kind of go straight into more kind of questions and discussion. Yeah, over to you.
Great. Well, thanks. It's great to be here with you all. And it's not, I haven't given a book talk, and so I'm not going to give a book talk. But I hadn't sort of. It's nice to get a chance to revisit and reflect on your ideas, because you write a book and then you're in a big flurry about it, and then you sort of move on to other things and forget a little bit about what you thought and what you said. And so, revisiting it, I didn't reread the whole thing, but I, by and large, are pretty pleased. I mostly still agree with myself. If anything, I think there's some things I would have added, a few things I would have changed, but mostly I'm pretty still satisfied with it, which is a nice feeling and a bit of a relief. So as Wen mentioned, I'm a lawyer, for better or worse. Yeah, I do have. I'm not an economist. I'm not a historian. I do a bit of those things in the book, but I'm not either of those things. And I do have practical finance experience as a practitioner, an investment professional, investment banker, and as a practicing lawyer. But I'm not an economist. Unlike, of course, Gary Gorton and Perry, who influenced my thinking a lot. I mean, as I said in the preface, I started thinking about these issues at the Treasury Department and the Obama Treasury in 2009 and 10, where I worked on the crisis team. And early chapters of Perry's book were coming through. Perry came through and talked to us. Gary Gorton came through and talked to us. We had read his Slap by the Invisible Hand. Both of those things circulated very widely within the Treasury Department in 2009 and 10, because we were all trying to figure things out. And those were really very clarifying. I don't think my book would exist if it weren't for Gary and Perry's earlier work. My thinking drew pretty heavily on them. So the thesis of the book, in a sentence, it's a book about financial instability, which of course was my obsession, a lot of other people's obsession at the time. And my argument is that financial instability is mostly a problem of monetary system design. And so building that argument out is part of what the book's about, and also sort of proposing a design, a concrete and I think realistic design that if you know about banking law, the New Deal banking system of banking law in the U.S., then you'll see that what I'm proposing is essentially following through on the logic of that system. We moved away from the logic of that system. I think we should have instead followed through on it, and I think that was a major wrong turn in U.S. money and banking policy and law. So let me just say a few words. I mean, so the book deals with a lot of topics. There's a sort of what is money topic, which is sort of a tiresome debate and a semantic debate too often. There are some who just take the axiomatic approach that it's a medium of exchange and they start their analysis from there. That's obviously not what I mean. But I also, I don't think money's a synonym for liquidity either. Stuff that has moneyness to it always has a very stable value in nominal terms. And so I don't think there's one right definition of money for all purposes, but from the standpoint of monetary system design and financial stability policy, I think that is sort of the most useful definition, is to think about things that are a medium exchange or that have a very stable value in relation to the establish medium exchange. And what that means in effect is short-term debt, right? The short-term debt of the financial sector has a moneyless property. Citigroup shares are extremely liquid. They're not money in my view. I don't think it's useful to think of them that way. Maybe there are some contexts when you can sort of collapse the concepts of money and liquidity, but I think, and the kind of analysis I'm doing, that's actually not useful. And so it's neither medium exchange, narrow thing, nor is it, gosh, anything that's liquid. It's essentially an intermediate definition, which I think, frankly, is also the definition that many, many others have arrived at in one form or fashion, whether it's some economists, whether it's accountants in defining cash equivalents, and central banks in defining the M3. It sort of always ends up in the same zone, and I'm not doing anything really novel there. I'm just defending it. I have some things to say about banking and money creation. I don't think I need to say anything about that for this audience. I do reflect a bit on the scholarly economics literature on banking, and which I continue to find somewhat perplexing in some ways. But I'm going to skip over that and just say one more thing about the foundations, which is that I think runs on money substitutes, runs on private money, are a key driver of acute macroeconomic disasters. And that actually turns out to be really controversial when you talk to people. Some people tell you that's obvious, and others will tell you it's flat wrong. And so, and then others will tell you, well, everyone's already said that before, so you're not saying anything novel. So you sort of can't win. And that's also true with the definition of money stuff and some of the banking stuff. It's like you get caught in this in these weird zones of cross-cutting, inconsistent criticisms. But I'm happy if it's obvious. Obvious is good to me, because if it's obvious, at least it means it's right. So that's all the sort of foundational stuff, and then I get into like, well, what's the design? What design principles come out of this? So, legal institutional design, and that's really what the book is mostly about, right? Again, I am a lawyer. I think we need to think about money as a legal institution, at least in part as a legal institution, if not all the way down. And so that means we have to talk about the law. And I offer up a sort of design sketch of how I would do our system of money and banking, monetary system design, whatever you want to call it, which is also the same thing to me as financial stability policy, ultimately, because I think financial stability policy is mostly about runs on private money, or at least ought to be. And so I sort of describe a system where there's these things called member banks. They're chartered by the government. They and they alone are allowed to issue money and money substitutes, and that's a really important thing. So I think entry restriction into the business model of money creation has to be a starting point here from a legal institutional design perspective. And when you start to think about it that way, so that is what we do with deposits. It's what we used to do for banknotes. We do not do it for modern money substitutes. We have a free entry into money creation regime, and I think I actually think it's really radical. And destructive, not just from a stability standpoint, but for other reasons also, which we can get into. So we could think of these member banks as sort of outsourced money creation, as sort of a joint venture with the state. There's a structure that goes along with it, which also draws on the New Deal banking law system, which involves portfolio constraints and capital requirements, restrictions on affiliations. I think seigniorage ought to be shared. So banks in this system earn what amounts to seigniorage, right? Fiscal revenue from money creation. And my view is we've outsourced this to them. There should be a revenue share associated with it. So that's a bit different from the New Deal system. Although the New Deal system, we do have to have, as Allison knows, deposit insurance premium, right? There is a fee stream running from the insured depository sector to the government. It just doesn't flow to fiscal revenue. But I think if we sort of rationalize the system, we can think about it a bit differently. And then finally in this system, and I'll stop here, is I envision it as sort of a cap and trade system for money creation. So these banks are, member banks are entitled to create money, but there's a cap that's imposed by a public agency, called a central bank or a monetary authority if you want to, that is then adjusted in the conduct of monetary policy. And so this is a system of public control on the activity of money creation. again, that's what reserve requirements historically were, right? I mean, the first thing you learn about money in banking in your macro text is that they call it of course, the money multiplier and all that, which is a bit of a silly story in some ways, but it is nonetheless true as a legal institutional matter that when you have binding reserve requirements, they are a cap on the amount of money that or deposits, whatever you want to call them, that the banking system could produce. So even the cap and trade is not exactly, it's not some weird departure from the legal institutional design or a monetary system. It's sort of a rationalization. And the last thing is that in this system, all money is sovereign and default and non-defaultable. So the money that the member banks issue is essentially the same thing as having a reserve balance at the Fed, right? There's no concept of default of these instruments. You can think of it as deposit insurance if you want to, but I'm trying to get rid of this sort of separation from the real fundamental reserve money versus the lesser bank money that banks issue. That's a sort of to me, a vestige of the past that we can at least conceptually do it right. So I think maybe that's already too much, Lynn. But in any case, I think that's the keys. That's sort of the key stuff from the book is really to think through those design principles based on the sort of foundational stuff I started with.
That's great. That's great. Thanks a bunch. Yeah, I think maybe one of the kind of first questions or kind of a group of questions we might want to discuss, which are, I think a couple of these we kind of sent ahead, is maybe kind of stepping back and doing a bit of a more big picture question. I mean, in your view, and in the kind of view of the book and the proposed reform system and this kind of thing, what is the purpose of banking? Is banking solely in order to provide people money and kind of an access the payment system? It seems like, for example, in the kind of reform system, it's very focused on de-risking banks to the greatest degree possible and just making sure that there's kind of quote unquote enough money in the economy. How should we think about, whether the banking system kind of accomplishes that, if there is too much or too little money? And do we lose something by focusing on the liability side as opposed to the lending side? So, for example, many people, argue that banks are kind of uniquely positioned in order to provide certain kinds of credit, say to small and medium enterprises or households that businesses might not. And then the last part of this is what is the role for other kind of money-like instruments in the reform system, like cash equivalents and this kind of things? Would banks still kind of provide that? Would they exist? I think you would rule them out of the non-bank system. No. So yeah, if you could elaborate on those kind of three, purpose of banking, what's lost in lending, and kind of cash equivalents in the banking system.
Yeah, so those are great questions. So yeah, I mean, the way I think about banking is in the reform system, and the logic of the New Deal system also it's outsourced money issuance, right? The government wants to issue a money supply both for itself and for everyone else, for the good of society. Money is an important thing, important form of infrastructure for commerce, and so this is a way of doing it. And we like issuing money in exchange for financial assets. There's a lot of good reasons for doing it that way, but we don't want the government maybe directly allocating credit. I mean, maybe we do, but I think there's an argument that we like to have some separation between politics and credit allocation. There's a lot of opportunity for corruption and cronyism there. This is an idea that goes back to Hamilton and even the Lincoln administration when they passed the National Bank Act. So I think of course banks have assets, and part of the role of banking law is to think about shaping those portfolios. What do we want to encourage credit? What types of credit do we want to encourage that might otherwise be lacking in the economy? And this is something that I don't talk about enough in the book. I sort of treat this as, well, let's keep it to safety. But we have a Community Reinvestment Act, right? I mean, this is one thing that's missing. We have different ways of thinking about, well, maybe we want credit. We want to use this now that we have these institutions that are out there issuing money in exchange for financial assets. Maybe we want to use the in exchange for financial assets part to achieve other public purposes. And I think that is part of banking law, and that's a bit of an omission from the book. But keep in mind, in the reform system that I enjoy, I mean, banks are just one type of financial intermediary, right? I mean, finance is this big thing, much bigger than just banking. And credit markets are a much bigger thing than just banking. That's true both today and in the reform system. Markets themselves do a lot of the credit allocation outside of the banking context. And of course, that wouldn't change, right? I'm not saying anything about restricting credit outside the banking system. I'm talking about the issue of the question of creating money substitutes outside the banking system. Those are important distinctions to draw. The too much money thing, yeah, I mean, I do think I think unrestricted issuance, especially if you have a implicit public backstop, leads to something we could call too much money, right? And I think this is a world we've been living in for some time. And I think it manifests itself as asset price. A lot of people don't like this term, asset price inflation, but call it asset price appreciation if you want to. I think we've seen, when you look at real estate markets, equity valuations, name your asset. You could even think of the crypto excesses in this bucket. I mean, when you have unrestricted money issuance coupled with a public sector backstop of those money substitutes, it's not surprising. You just have a big put option written behind the financial markets, and you should expect that to lead to an increase in asset prices. And so I think it's really damaging. I think it's really damaging for democracy. It's really damaging for society. I mean, JJ's graduated from college. I mean, JJ, I hope you have some wealthy family members who are going to bestow upon you some property. But if you don't, it's pretty rough. It's pretty rough. I think we're seeing a lot of social stratification that comes from a society that's built around assets and who has assets and who doesn't, as opposed to the way it used to be more about around your income and around your profession, was where class. So I think there's sociological dimension. I think there's economic dimensions. And so, yeah, there is a problem of too much. And I do think we want to think about the way in which money goes into the economy, right? Have that be publicly directed, as opposed to decided by institutions that have no public responsibility whatsoever, but are only looking for their private interests. And I think we want to have the public say how much there is through an administrative agency.
And just a quick follow-up on that. And what about kind of too little money? I mean, in the book, several times you mentioned that certain kind of constraints or regulations may prevent banks from being able to issue enough money. Is that kind of a major concern, or?
Yeah, I mean, and so look, of course, historically, that's actually why we created a Fed, was deflationary problems in the old system, right? And so, and you could think about, financial panics as rapid contractions in the money supply. I think it's a more complex phenomenon than that. But yes, too little is just as much, maybe even more problem than too much. Because you end up with anemic growth and high unemployment and material deprivation and suffering that comes from that also. So look, this is a primary job for the government. This is a basic task of government, is to have a stable and well-functioning monetary framework that ensures that neither too much or too little is created. And how do you know how much is too much or too little? I mean, I'm not having, some people interpret me as advocating like a Friedman type rule, where we want like some stable growth in the life. That's not at all what I want, and I don't say that in the book. I think if unemployment's getting too high, you probably want to increase the rate of money growth, and if inflation is getting too high, you probably want to reduce it. And you want to think about the way money is being issued so that we don't get weird asset price distortions coming out of the nature of the structure under which it's issued, and that's why this is a public responsibility. I don't know if that fully answers your question. I'll just say on the cash equivalent question, yeah, member banks would issue, and only member banks would be allowed to issue cash equivalents, and they would also be sovereign and non-defaultible. In other words, at maturity, they would just turn into what I call our currency. Actually, a little bit regret that terminology because I think it may have confused some people, but they would become account money upon maturity, and there would be no kind of concept of default. So there would be these risk-free, essentially like treasuries that the banking system could issue. But you could not issue that if you weren't a member bank, right? The prohibition, the entry restriction provision, current law has under current law, you cannot issue deposit balances if you don't have a banking chart, right? It's like a fundamental thing in banking, as Allison knows. And right, well, you can't just set up a corporate charter. I can't go get a corporate charter in Tennessee or Delaware and just start having deposit balances as my liabilities, right? That's unauthorized banking. I can be criminally prosecuted for that actually under federal law. So we already restrict entry into the creation of deposits, but we don't do it for all these deposit substitutes that are accomplishing much the same thing. And so I think we need to re-engineer and update our that prohibition. And so yes, only member banks and only member banks would issue cash equivalents in my ideal world.
Great. Thanks a bunch. Maybe stop and see if other people have a question. I see a couple people have put some in the chat here. I don't know if someone wants to go ahead and just kind of.
Yeah. I wanted to push a little bit more on this particular topic. And my question is, so it sounds like if the amount of credit and lending the economy needs is greater than the amount of money that it needs, then you have these non-bank financial intermediaries that can provide the additional credit beyond the credit that's being funded by money creation. But my question is, what do you do if the amount of money the economy needs is greater than the amount of lending the economy needs?
Yeah. You know, I mean, that's something I don't address in the book. And I don't honestly know how realistic it is, but it might be realistic. And it's probably something I should have addressed. Look, so let me back up for a second. I mean, it used to be, so under the old national banking system in the late 19th century, right, national banks were the only issuers of banknotes. And they could only issue them in exchange for, they had to be secured by Treasury securities. And so what that meant was that the quantity of hand-to-hand currency outstanding was constrained by the amount of treasuries outstanding. That turned out to be a really bad idea. By the way, it was foreseen that this would be a bad idea. Salmon Chase, when he proposed the bill, said, you know, look, this is a potential future problem. We're in the Civil War right now. We got a huge amount of debt, so it's not a problem. But one day we could face a situation in which there just isn't enough Treasury debt out there to accommodate the desired money supply. And in that case, we'll have to amend the law. And that's not what happened because banks ended up getting around the whole thing, as you guys probably know.
I thought it was a special kind of Treasury debt that was created just for the national banking system. Like it wasn't, you could just take a regular Treasury security.
Yeah, I mean, there were limits on what could be owned, but the basic principle is what you're saying is not just a hypothetical problem in the sense that it's conceivable to have circumstances under which there just isn't enough of the stuff out there to accommodate the desired money supply. And then what do you do then? And you know, look, the credit markets overall are just enormous. You know, many tens of trillions of dollars. We may be over 100 trillion in credit markets right now. And it's seeming, I'm just talking about the whole credit market, which is, it's hard to imagine that the desired money supply, or the needed money supply, the optimal money supply, whatever you want to call it, would be in excess of that. But it's theoretically possible. And if that were the case, I think the government would just have to start crediting accounts and issuing money either in exchange, directly in exchange for goods and services, or you know, helicopter money type thing. And I don't get into that book. It's sort of assumed in the book. The way I put it is that, look, we do want to put portfolio constraints on banks, but those need to be lenient enough to allow the banking system to accommodate the desired money supply. That's the way I put it in the book. So you can't just say banks can only own treasury security. You know, the old narrow banking kind of thing disregards this question that you're asking. So that again was a long-winded answer, but I think in the eventuality you're talking about, you need helicopter drops or something of that nature.
Yeah, that's the answer I was looking for. I guess from my, tell me if this sounds wrong, prima facie, or absurd, or something like this. But my impression of kind of what's happening with the credit markets right now is that part of the reason they're so big and so unstable, and there's so much kind of, I don't know, bad credit or whatever in the economy, is because we need money. We've been stimulating the financial sector to ensure that there's enough kind of money floating around in the economy. So you get maybe more private credit than is reasonable to have. Does that sound like a hypothesis that's within the realm of the real world, or does that not sound right?
Yeah, I'm not sure I'd phrase it exactly that way, but I think you're expressing something that's close to what I think, which is, look, it was basically around 1980 that we really liberalized the monetary framework in the U.S. and you see money funds, you see tri-party repo start to grow, you see Eurodollars really turn into a multi-trillion-dollar thing, and all this stuff starts to happen. And coincident with that, we see secular decline in interest rates from about that time, which you issue more money, you expect rates to go down, right? We're allowing private entities to do it, but this is how the Fed reduces the money interest rates, is to essentially issue more money in exchange for financial assets. When you allow financial institutions to do it unfettered by any kind of regulatory requirements, you see the same thing. We see rises in asset prices, which go along with sort of lowering of interest rates. And in particular, that happens because of the way in which we haven't imposed any public requirements on the way that that money is issued by unregulated financial institutions. And so you do see too much credit, and especially when you have a central bank backstop behind the whole thing, which we do, and we've seen materialize multiple times now. Both in 2008, of course, and late 2019 with the Treasury market hiccups, and the Fed comes to the rescue with several $100 billion of loans to primary dealers, and then of course in the COVID situation. And so what the market learns is, oh, we could do this, we could fund ourselves this way. It's really cheap, right? There's a moneyness premium at the short end of the curve, so they're essentially extracting what I would view as seigniorage by virtue of that. It's all backed by the central bank, right? We don't have a real problem here. We're not going to be allowed to default, and we can invest in whatever the hell we want to, and that gets directed in certain ways. And so I do think you get too much, right? You get too much credit, and not only too much, but you get it in ways that are not publicly directed, which I think it should be a little bit offensive to us, because it's based on the central bank, right? I mean, it's all off the public at bottom. I call it the monetary financial complex. Lebanon and I are writing a paper now titled "The Monetary Financial Complex." And this is what you end up with if you don't restrict entry, but you have the Fed out there with sort of a roving backstop. What happens in the private sector? It doesn't take any great economic mind to understand that creates some perverse incentives, and there are certain winners that come out of such a system. If the central bank's in the middle of it all, then it stands to reason that the public should be directing how this works. So that's my own philosophical view.
I know Larissa has another question, but I just want to ask something that's kind of a follow-up on this before we kind of change subjects a little bit, which is one of the things that you mentioned in the book, and in this kind of regard, is that the lender of last resort system that we have, where we kind of allow banks or the financial system to provide credit, in a sense, subsidized by this backstop. The suggestions that this kind of leads to an excess amount of credit and investment, but it feels like in the kind of public-private system, where you have, instead of a kind of contingent backstop, you have this explicit guarantee that there's, in a sense, it's just, I guess the question is, how do we think about whether one of these systems is excessive versus not? Like, what is the appropriate benchmark? I mean, I understand in the book you have this kind of model where you're trying to think about what would the cost of financing be if it wasn't kind of using this money premium. But could you elaborate a little bit on that?
Yeah, I mean, it's a great question. Look, nothing's perfect, but the regime the reform system I propose is one in which you're charging fees all along, right? And you're trying to, and it's not easy, but you're writing a put option, right? This is similar to pricing deposit insurance. Sorry to keep coming back to you, Allison, but we do risk-based, since Fiducia in 1991, we do risk-based deposit insurance premium, where at least in theory, we're sort of like trying to charge you more if you're riskier, and trying to charge an actuarially fair rate for the put option that we're writing. right? Writing insurance, we're going to charge for. That's not the way the lender of last resort works, right? The lender of last resort is like a standing backstop with no commitment fee associated with it. And so if you charge the right amount, and I admit that's a big if, and it will never be perfect, but if you charge the right amount, then banks' funding costs are the same as they would be if they funded themselves in the capital markets like every other entity out there, right? You're approximating a market rate of funding. And so that's a very different world from an unrestricted central bank world. And in addition, it's important to remember in the system I'm describing, right, it's capped ultimately. There's a reserve requirement type cap on the total amount of money that's being issued by the system. So it's not ad infinitum, issue whatever you want and we'll backstop it all. We're designing constraints within the system, and we're charging ongoing fees that actually flow, again, in my system, flow to fiscal revenue, right? Right now, deposit insurance fees flow to the deposit insurance fund, the DIF, and then when that gets fully funded, we just stop charging them. and that, I don't think that's a great design, right? I mean, we're providing this exorbitant privilege. There's no reason not to charge for it. This, by the way, was Andrew Jackson's basis for vetoing the second bank of the United States. Not to cite Jackson as any kind of heroic figure here, but he wasn't necessarily wrong about everything. And if you go read his veto message, it's really interesting the way he thinks through this, because his real complaint is we're bestowing this huge gratuity, as he calls it, on the stockholders of this bank. Why not auction off the charter and at least accrue to the public the value that should come from bestowing the privilege, right? This should be a quid pro quo kind of thing, not just a grant of privilege to what amounts to an aristocracy. And we're just going to give them more? This is the question he's asking in the veto message. And I think, I mean, the guy didn't always have a point, but maybe he had a point here. and so there's a little bit of that analogous thinking going on in my treatment at the lender of last resort versus the insurance model.
Right. Cool. Larissa?
I think one of the questions that I had which was just on more on like what this means for credit markets, has somewhat been answered. But we had read The Rise of Carry, that I think is very much, it's by Tim Lee and Kevin Calderon. They also describe how central banks are writing this massive put, and like what does this mean, and like the consequences to society.
Is this a book? I'm afraid I may be a little behind on the literature, but what is, you said the what of Carry? What is it?
The Rise of Carry. So I believe it was written, it was 2019.
Yeah, Tim Lee, okay.
They generalize the term carry trade to describe what you call banking or shadow banking.
Oh, very interesting. Okay, I regret that I didn't see this, but I'm going to go read it. Thank you.
No, I think the arguments of the book actually really resonate with your latest point of that you're writing a put and then not charging at all for it. Like, so what does this mean? And like, what does it mean for like as a consequence to distribution in society?
Yeah.
So
sorry, go ahead.
No, but I just want to add, so like very much in line with what we've been reading. I guess I had two questions. One was just more like reflections on what you would change about the book, as you had opened up saying that was, you had like a few minor points, but on this latest discussion that we were having, I think it would be helpful for me to just get a little bit more of your sense on like how like the business models of credit markets could change, because it seems like it would require a shrinkage, just because they would no longer be able to issue short-term debt the way that they would. So their issuance would be more expensive. So it seems like credit overall would be more expensive.
Yeah, I mean, I think that's true. But you have to sort of think of this in general equilibrium, I think, and so let me back up. So I will read The Rise of Carry. I mean, I think on the district, there are really, really important distributional consequences, and I think macroeconomic consequences associated with how we decide that the monetary framework works. Who's allowed to issue money, and what is their relationship with the state? And those are just really super basic questions that honestly often get abstracted away from in economics. And I think we got to bring those into the center. This is a political economy question as much as it is a technical question, and that's part of what I left out of the book, I think. Because I was thinking from stability standpoint only at that point. I like to think I've broadened my mind a bit since then, but I think about it more in political economy terms, I think, than perhaps I did in distributional terms. And macroeconomically, it's not just the risk of panics, but it's also what happens in normal times. What's the relationship between the design of our monetary framework and secular stagnation, or the global savings glut, right? So I'm doing a little Summers here and a little Bernanke, but I think all these things are very closely connected to the actual institutional design of our monetary framework, which is something over which we have choices. And I think there's an insufficient recognition of the fact that there was a major liberalization around 1980. Also, the time we were deregulating a lot of other infrastructure industries and everything else. But this is one of the forms of infrastructure that we also essentially deregulated and liberalized. And I think the consequences of that, I personally think, have been catastrophic. But they need to be part of the conversation, right? I mean, let's have this as part of the conversation. Business models, yes. So dealer firms and hedge funds and the conduit businesses, which aren't as big as they were in the pre-2008, the asset-backed commercial paper and all that stuff, would have to term out their funding. And so bid-ask spreads would get higher, right? I mean, if dealers can't fund in the overnight market, their cost of capital go up. That's going to pass through to bid-ask spreads in the capital markets. And I just think, so what, right? I mean, to me, the current bid-ask spreads are subsidized. And so removing the subsidy is not like a social cost. We should ask the question of whether the subsidy is justified on some economic ground. Like, is this really, of all things we can subsidize in the world, is bid-ask spreads the thing? What's the market value we want to point to say that we need to do this? We need to have this back. We need to allow money creation to happen here. We need to backstop it so that we can have more trading. I mean, we worry already we have too much trading. We talk about transactions taxes. We have people are worried about the instability from high frequency trading. Like, the idea that we just need more trading is to me a real questionable idea. And I think the burden of persuasion is on those who want a subsidy for this, not on those of us who want to take it away. So there's nothing about the dealer business model that requires overnight funding. It's just more expensive to term out. That's all it is. It's more expensive. So be it, right? So be it. Finance is probably too big a part of our economy already, a large part because of this. And I think right-sizing the financial sector would be a good thing, not a bad thing. And so I'm not worried about less trading. Higher credit costs, yes, but it's in the context of a broader consideration. Look, if we want to subsidize credit, let's think about the right way we want to do it. And subsidizing trading markets or secondary spreads in the secondary market is not obviously the best way to get credit where we want it on the terms that we want it. So if we have desired outcomes we want to achieve in the credit markets, let's think about doing those in a more direct way, in ways that isn't siphoned up to finance, which I think is really regressive. But it's hard to say in sort of general equilibrium what credit markets look like. I mean, yeah, costs of credit are low by historic standards, but like if you want to borrow to buy a house, well, asset prices are high. So like, I don't know. In my world, I think asset prices would be lower, and yes, your mortgage may be a bit more expensive, but you would be a lot smaller. So I don't know how that shakes out. I need someone smarter than me to figure all that out.
Yeah, I mean, just to kind of follow up on that, because it relates to the question that I was asking earlier. I mean, I think for the most part, I agree that, wider bid-ask spreads and financing costs in capital markets are not something, and in securities markets in general are not something that we need to be super deeply concerned with. But I do worry a little bit more about on the banking side, right? Where, especially if we're trying to think about the distributional consequences. I mean, there's kind of a large literature on financial frictions that result in kind of credit rationing and lack of access to credit for small businesses, for households due to information asymmetries and these kinds of things. And so, I guess one of my major kind of pushbacks would be that it's not immediately clear to me that a subsidy in this area of finance is necessarily bad because of the distributional implications on the banking side, as opposed to kind of securities markets and this kind of thing.
Yeah, well, so I agree with all that, and I think we should look, if you're going to have a banking system where you're outsourcing money creation, and you're going to have a $10 trillion portfolio or a $15 trillion portfolio that's the assets of the banking system that is acquired in exchange for the money that's issued, then you should say something about the assets. And again, this was an oversight in my book, I think, or I didn't say enough about this. I just said, I'll keep it relatively safe, but that disregards the full extent of the public policy possibilities here, which is that we can't, and we do, by the way, of course, risk weights for mortgages, right? If we want to give direct credit toward residential real estate, we can do that, and we already do it through capital risk weights. And you could do it through risk weights. You could do it through lowering the seigniorage fees that I'm talking about charging for that are associated with particular asset classes that the government or policymakers want to encourage. You can have a community reinvestment act, hopefully a good one. Ours right now is feeble in a lot of ways, where we say, look, banks, you have essentially a franchise area, and you've got to serve every community in your franchise area. You need to meet the needs of your entire community, the credit needs of your entire community, and you can do that when you have a banking system that is working in partnership with the government to issue the money supply. So I think those possibilities are very real. And when I don't know if that's a complete answer to your question, but it does present an opportunity, and a missed opportunity in my book, but it's an opportunity in this design to direct credit at least some kind of sectoral level. I'm a skeptic of having the federal government, or at least political agencies, and even the Fed, be in the business of directly allocating, making individualized credit analysis and allocation decisions. I mean, there may be circumstances under which that's fine, but general, it's such an opportunity for cronyism and corruption that I think, outsourcing this to banks, that one of the big reasons to do it is we do want to harness the profit motive, but that doesn't mean we can't say something about how it's directed, right? And I think again, this was something I left out of the book that should have been there.
Sure, and we recently in this reading group read Eric Monet's Credit Controls book, which talks about kind of these aggregate and sectoral level credit controls that were used by the Banque de France in the post-World War II era. And they often had a little bit of this flavor, kind of prioritizing, important public policy sectors like housing or trade or this kind of thing.
Yeah. I mean, it's an opportunity, and I don't. It's an opportunity when you start to think about banking through this lens.
Sure. I think Allison had a comment she wanted to make on the relationship between kind of the lender of last resort versus deposit insurance policies. I mean, I don't know if you want to bring that back into the conversation.
I mean, sure. I guess I just have a question. The credit allocation piece I'm struggling with a little bit, just because it's not bright lines to me, right? When you consider like the GSEs and they're sort of feeding the credit and the securities market. So I have to think about that side a little bit more. But on the liability side, I'm 100% with you, in terms of the lack of a sort of accountability, I guess, for a better word, right? For money market mutual funds in particular, that's just an easy target. We all sort of know what they are. And I think, in my head, like the solution there is a comparable insurance fund, right? That you pay for. And I think that is an easier sort of approach, is just maybe taking the banking framework, which, I think is logical, as you say in your book, and maybe just applying it out a little bit, broadening the scope, as opposed to, maybe redefining the whole monetary infrastructure, which, I mean, I'm a creature of DC. We don't do those big overhauls well, right? But we do little incremental changes we can handle. So I guess just your thoughts on just, and I know that the devil's in the details, but just generally as a thought exercise, just sort of an insurance fund for money markets. And maybe would that solve some of the problems without hurting the credit side?
Yeah, so I think it's a great question. In fact, you're starting where I was, and originally when I was at Treasury, actually, I wrote a memo to Geithner saying, well, we need to just use the insurance model more broadly. Like dealers should have to pay. They should have their repo insurer essentially, and they should have to pay a fee for it, right? We're standing behind it anyway. We might as well like charge for it. And I think part of it comes back to the asset stuff, and it comes back to the aggregate cap question, and this relates to the money fund thing, right? So you do get the stability benefit from that, but I think there's a broader set of issues at stake in designing a monetary framework that would not be captured by simply setting up another fund and charging fees to, say, money funds, right? I mean, we care how much is issued in the aggregate, and that's the way reserve requirements again used to work. Is that they impose a cap on the aggregate amount of deposits that the bank system can issue. By the way, there's also a cap, an explicit cap in the old national bank system, right? We always previously thought, well, this is a system, it's working as a system, and there's public control over the aggregate quantity. And so that's not going to be ad infinitum. And you don't get that, right? You don't get the full systemness by just setting up more funds and guaranteeing more things. And you also are not directing. I mean, you had some reservations about the directing of credit side, and I actually agree with you on the GSEs. I mean, I think directing credit toward residential mortgages mostly, to a significant extent, increases asset prices and flows into, as opposed to directing credit toward sort of real economic activity to the extent we can, and that's. Would be my own personal preference, but I could see arguments both way on that. But the point about money funds, surely, and yes, I would much prefer to set up another diff for the money funds and charge them fees than to have the system we have now, which I think is pretty bad. But it doesn't. To me, that's a sort of stopgap measure, but I'm not disagreeing with you about the sort of political realism and DC realism, right? I have the luxury of sitting in the ivory tower and writing a book about ideal forms, and ideal forms never really materialize, but they do sort of help us, I think, sometimes to see what potential problems or limits there are in other reforms.
So I want to be a little bit cognizant of our time, and we don't have a super hard stop here, but two questions that were in the chat that I think are kind of interesting for kind of broadening this out from the kind of like core conversation that we've been having so far. Jay had a question kind of about the international dimensions, and then Larissa had one kind of more about some of the kind of stable coin and technology and kind of innovation side. So I don't know, maybe Jay and then Larissa.
Yeah, great, thanks. When my question comes to, I'm not sure if you're aware of another paper we read by the BIS on the triple coincidence, basically that making the argument that currency that no longer coincides with our regulatory areas. And so for most countries in the world, that means that the internal use of money does not consist of their own core currency plus the dollar. And for the US, that means that the dollar is much more widely used than within the regulatory framework of the US. So we're talking about the euro-dollar market and the offshore market. So basically, this comes directly to the core of your book, which is a design question. Obviously, you're trying to realign public purpose with the use of money and credit creation and so forth, where in this case, there's a huge amount of private credit that is being demanded. So my question is more like, obviously, there is a design question that has to be solved here. If we take on that there was a huge demand internationally for dollars, how do we align that domestic currency with the international demand for dollars? I don't remember that this really constraining the use of the dollar is actually a bit of a problematic view here, and also not that we actually have a hierarchical sort of problem here, that we have different issues to solve. So I think that's the big curveball in this whole story, in my view. How do we actually solve this particular problem? Because I could imagine that that a lot of this credit creation that we're talking about is actually driven from this international angle that's enabling this U.S. system to blow up the way it is, because international actors love to backstop their private dollars with U.S. capital market instruments, which is why we have a repo market, which then creates the risk in those repo markets on short term. So we have this sort of thing that is 3 steps removed, which is not really the core of your story, but is something that the system has evolved over these last 20, 30 years to, which is the flip coin of internationalization of the world economy. And so I'm just wondering how you think about that particular question.
Yeah, no, it's a great one. And, so I think we need to distinguish between the use of dollars abroad and the holding of dollars abroad on the one hand, dollar instruments abroad, with the issuance of dollars by non-banks, whether abroad or in the US. And so use is different from issuance, right? I'm glad for the dollar to be the reserve currency of choice, for central banks to own treasury securities, for people to use the dollar in international finance and dollar instruments. But that's a different question from whether non-US financial institutions are funding themselves with dollar-denominated overnight instruments or euro dollars, et cetera. And so it's the latter, I think, is a really, really big problem. And in fact, I think this is what the Basel, original Basel Accord should have been, not even a capital accord. Let every country do whatever they want to on the capital side. We don't need to align capital requirements. We need every country to have control over its own money supply, right? And so I do have a problem with, say, Santander having a huge quantity of liabilities that are short-term or overnight that are dollar denominated. And I don't think that for people to use the dollar requires Santander or Bank of Tokyo, Mitsubishi, or whatever other financial institution you want to imagine to do that, right? I mean, they can hold dollars on a custodial basis, dollar instruments that are issued by US banks, and then supply that to their own customers on a custodial basis, right? On a trust basis. Everyone could use dollars that way abroad. They don't need it to be issued by those institutions. And so that's the distinction I would draw. And I think we got to get a handle on this, or the whole thing is doomed, right? There's no point in restricting entry into money creation if we just let it happen anywhere abroad. And this is analogous to me to pollution spilling overseas, over borders, or intellectual property piracy in other countries, right? When we care about things, we deal with them multilaterally. And this is one I think we should care about. So Jay, I don't know if that answers your question, and I get versions of this question a lot about the international dimension. I think it's a real abrogation of monetary sovereignty for non-U.S. financial institutions to issue money substitutes denominated in dollars, right? It's a stability problem. We're backstopping it all in the same way we are the repo market, right? That's what the central bank liquidity swaps are for. They're even bigger than our backstop of the repo market, right? It's as I alluded to earlier, I think global imbalances of the type that Bernanke has written about, you could think about through this lens, which is about dollar money creation abroad, right? So I think it leads to imbalances. There's stability problems that we have to contend with, and it leaks seniorage away from the American public, right? I mean, we should be earning. If people want to use dollars, then we should be accruing the benefits of that. So that's maybe a little long-winded, but that's my short reaction.
So I just want to check, since we're at roughly hour mark. We started a few minutes late. I don't know how you're doing on time. I think we have one or two more questions.
I can do 5 more minutes or so, just
cool.
fine. So yeah.
Great. So Larissa has a question, and then I forgot Alex also has one more question that
okay. I'll try to be more try to be more efficient.
Cool.
Yeah,
Thank you.
and please feel free to not take this question. I work in crypto, so I don't know if you have any interest or you follow it at all. You know, just because I work. Okay, as I work in crypto, I always have to ask a question. So just curious on your thoughts on like the current debate around stable coins and stable coins regulation. Should it, you know, to what extent does it fit within your framework? Is this an opportunity actually to experiment with different institutional design, and given that there's rapid experimentation in the crypto space? Just curious about your broad thoughts.
Yeah, I'm a pretty big stablecoin skeptic from this standpoint. I think it's just like a money fund. You know, it's demandable liabilities, dollar denominated, with a portfolio of financial assets, in this case, quite opaque portfolio. And we see this business model, it's cropped up many times over history, and it tends to never end well unless there's a backstop. And I think it's big enough there will be a backstop. So I'm all for innovation, right? But we can have innovation within a setting in which we're not completely liberalized into who can issue money substitutes. And look, I'd like to see faster payments in the U.S. I'd like to see bank-based payments work better than they do. I think we can have innovation in things like Venmo, payment intermediaries, and including stablecoins, as long as they hold full reserves, right? Payments is one thing, but the money augmentation is a different thing, and that's the problematic aspect of the stablecoins and these other business models, in my view.
Alex, do you want to jump in with your last question?
Yeah, so you talk about in the book how you have this banking game theoretic bank run model where you're either in the good equilibrium or you're in the run equilibrium. Perry Merrill has a different story about the mechanics of kind of a credit contraction, credit collapse, that's fueled by what he calls a liquidity downward spiral, in which actors have no choice in their actions. So creditors are forced by their own settlement constraint to withdraw short-term funding. So the idea is that complete confidence and faith in their counterparties won't change the result. You know, a run can happen completely involuntarily. And the story is, you know, part of the story is that I'm maybe borrowing, you know, by issuing monetary liabilities or cash equivalents, and I'm using some asset as collateral, and then the value of that asset decreases, and then I can't roll over my funding anymore, and then I have to sell the asset, which causes the price of the asset to spiral downward in kind of a chain reaction. Yeah.
So they are different. I don't know if it's there's a distinction between his view and mine. I don't know how much of a difference it makes in terms of how I think about the design questions. And I think, like, I have this whole thing on Diamond Divic. I mean, on one hand, yes, Doug Diamond will probably win the Nobel Prize. Maybe he deserves it for that model. But gosh, does it not look like a bank to me, right? It looks like something else. And so I was just trying to say, I do think there's probably a self-fulfilling dimension to bank runs. In other words, people run at least in part because others are. Perry's story, as you're articulating it, and also as I remember, is a bit different in the sense that asset values decline, you get essentially a collateral call, and you've got to reduce your liabilities. And that's not a self-fulfilling story. It may be a cumulative process. Yeah, as you put it, involuntary story, but involuntary is not the same thing as self-fulfilling, right? I was just trying to say, I think there is something to this idea that people run in part because they expect other people to run, right? You see the line outside the bank, I mean, in the classic sort of example, and you go get in line because, like, oh, well, everyone else is running, I better run before it runs out of money. But ultimately, my argument in the book doesn't really hinge that much on that model. It may have been a little bit of a tangent in some ways, although I was trying to get to the bottom of what I think is the right way to think about the banking business model. Alex, I don't know if this is helpful to you. I don't disagree with Perry. In fact, I think the way that panics affect the broader economy is in part the Perry story, and Jeremy Stein has told the story also, where there's a bunch of redemptions. set aside exactly why they happen or whether they're self-fulfilling, but a lot of assets got to get liquidated to meet redemptions. And when there's all this liquidation, asset prices, right, financial asset prices are going down, which is another way of saying that yields are up. And so new issuance in the primary market has that hurdle rate of the existing yield in the secondary market. So pricing in the primary market of credit suddenly gets way higher, and you get way less credit creation. And so you get a period like 6 months in 2008 and 9 where there's like no new credit being created. And not surprisingly, the economy falls into a steep free fall because spending and investment rely heavily on external financing. So I think that story's right. It's a different story than like the Friedman Schwartz depression story, which is just like the money supply shrank and lo and behold, the economy shrank also, right? I think I'm not sure I find that very convincing. I don't know the right way to think about that, but I find the Jeremy Stein-Perry way of thinking about this a little clearer. I think I link it to the broader economy a little more directly than Perry probably does. But that basic mechanic is, I think, really absolutely essential, and it's not mutually exclusive with the self-fulfilling run story either.
Yeah, I guess the main reason I asked about it is because you could, quote unquote, panic proof the economy and prevent the self-fulfilling runs, and you'd still have this other thing there.
Oh, yes. So fair enough. Yeah. Fair enough. So it does raise the question of what the more important dynamic is. So I think that's a fair.
Yeah, I do like the model though, and I think it's right and it makes sense, and I like it better than the diamond dig model. So in my mind, you win that debate.
I appreciate that. Well, I'm not getting a Nobel Prize, but
Okay, well, I mean, I think we could easily stay here and talk about this a lot more, but we should go ahead and wrap up, and hopefully we can kind of continue this conversation another time and another place on other topics. But thank you so much for joining us, Morgan. It was really a pleasure.
Yeah, thank you guys, and it's really delightful for me to see so many people, young scholars and others who are thinking hard about these questions. I think. Certainly, when I got into this, it was a much newer thing, and it gives me hope to see so many smart and engaged people thinking about these issues. It's encouraging.
Great, thanks.
Yeah.
All right, thank you.